Welcome back. We're looking at number 3 for challenges to market efficiency. And this one is going to be a little bit simpler than the other ones, I think. And we're going to try to get in and out of this as quick as possible. This is using the measure called price to earnings ratio. And what we found here is when we stack up all the different PE ratios, price to earnings, we find that low PE ratios outperform companies with high price to earnings ratios. And this follows on the heels of what we talked about in the previous video with value outperforming growth long term. It's following the same line of thought where low price to earnings ratios outperform the ones that have higher or inflated valuation. So remember, price to earnings means that this is the amount of money people are willing to pay for the stock for $1 of earnings. Okay, so just remember we've got earnings per share, and we find that this company that I'm making up here is $5 earnings per share, and the stock price is traded at $40. Earnings per share is 40, or price to earnings is 8. This is our ratio. But we're also saying essentially that for this particular stock, if you're going to buy it at 40, you're willing to pay $8 for each dollar of yearly earnings. So with lower, something below 10 is usually something that's pretty attractive, showing a low price to earnings ratio. For some of these growth stocks, some of these higher valuated stocks, we can actually get some pretty monstrously high numbers where they're eking out 50% profits and they're trading at $100 based on some real significant growth aspirations. And you can see here, that would be a 200 price to earnings ratio. So once again, this can fluctuate quite a bit. And what we would do here, we have a whole list of different stocks that we're looking at, trying to show if this is true or not. We can use a couple of different proxies. I'll do the lowest 10% and match it against the highest 10%. See if these earnings, even after factoring risks, are true. And that's what we did here. Highest PE, 10%. So if we're looking at this and we found out that, yeah, historically this is true, we're thinking long term, then let's ask you first, why are we, how does this challenge market efficiency? So when we think about that, we realize that based on the market efficiency definition, all prices and values should already be factored in. It should be captured by beta risk. This particular measure, if everything's priced appropriately, shouldn't get us anywhere, certainly shouldn't get us excess returns. And that's the challenge. Why is this giving us excess returns? And just by looking at the price to earnings, if everything is priced correctly. And if we were believing in this, and believe this will continue, then the action point on this would be we're going to look and try to buy low price to earnings stocks. Now, this always doesn't work because there are some companies out there from Michigan. And so I think of a Ford company, and you see they have a low price to earnings and have for a very long time. But the reason behind that is because they have a really weak balance sheet because they're still paying pensions for some of my family members who are still alive and from who haven't worked at that company for 20 years. And so it's causing a big headwind, and they will probably always have low price to earnings. So just be careful, but in general, you can see how this might benefit you in your stock screening process. Said I would get in and out, so I'm going to stop right there. and I'll see you on the next video. Thanks.